Hey, welcome everybody to Jeff Cait's show. This is early retirement discussion, and it asks the question, what about long-term care costs? All this interest in early retirement is exciting. New CPP and OAS rules, people optimizing withdrawal rates, deferring timing, planning to retire at 60, and I want to be helpful. My mother made sacrifices for the welfare of the family. And when my father died at 52, she was 40, three teenagers. She had no money. She ended up working in a shoe store for 25 years. And I remember the kind of mother she was. She wouldn't eat very much because she wanted to save the food for us in case we were hungry. And I recall that she used to tell me that she would hear a siren late at night, an ambulance, a police car, a fire truck, while she lay in bed in Toronto. And she'd wonder if I was okay in Mississauga. She did amazingly well with what she had. And she lived her life that way, family before self. And I guess it made me feel somewhat the same. Life insurance is about unconditional love. And when she needed long term care at the end, we sold her house, and that's how we paid for it. Now, if you're planning early retirement, here's one more piece worth considering: plan for the worst and hope for the best. Not everyone should do this, but everyone should see the math. And let me show you. Here's the timeline everyone planning early retirement needs to see. What you have is the age 60 to 75. I call that active retirement. 0%, $0 coming from CPP and OAS because you deferred it to age 70. The care costs are nominal zero, and you're living on your RIF and savings at that point if there's a shortfall in what you need. And at 75 to 85, you start slowing down. Government income, we put a number in there, 21,840, the max. Care costs 5,000 per year. You have some minor care costs, and it's manageable. But I think about 85 to 95, where you require care. All you have coming in from the government is 21,840. Care costs we put at 10,000 a month, $120,000 a year. And there it is, the annual shortfall. 21 coming in, 120 going out. There's a shortfall of almost $100,000 a year. And if you multiply that over 10 years, you have a shortfall of almost $1 million. And I asked the question, where does this money come from? Your RIF, and it could be you're at a stage where it's going to be depleted in 3 or 5 years. And you can look at the kids, but, they're trying to retire too. And you can consider selling your house, while you're in care. It might make it more challenging, but those are the options. What I think is, here's the question everyone asks when I say, hey, life insurance for long-term care. They say, can I just change the beneficiary to the nursing home? And the policy contract actually says yes. The owner may designate a beneficiary of their choice without restriction. No insurable interest required after policy issue. But the reality today is nursing homes haven't embraced this funding model yet. They're just not set up to accept life insurance death benefits as payment for care. But there's something better. Even if the nursing homes eventually adopt this, let me show you something that's better. I call it the LTC, long-term care life insurance approach, the family agreement part. Purchase $1 million of life insurance before retirement, cost, say, $500,000. Ages 60 to 84, the children receive the $1 million and they split it equally, tax-free death benefit. But if you make it to 85, the child who coordinates care, who has more than his share, gets a larger share of the $1 million of tax-free money. The key is to have the conversation now, not wait till you're 85 and you're in crisis mode. My good friend Roger Cooper, he does some exceptional work with family planning. I call this the Cooper Family Vault. Real family, real planning. The situation I used is hypothetical, but if you have an age 60 parents, the three kids, 32, 35, 38, and life insurance $1 million, in the agreement, you could write something like the child who coordinates care, 50%, the other two children, 25%. All three agreed it's fair, but the key to the thing is have this conversation now and don't wait till age 85 when you're in crisis. So here's what it costs. That's a big question. And the answer is that if you do it at age 45, we optimize 9767, our virtually guaranteed product. pay it for 40 years to age 85, which is optimal. Assume a 3% policy interest rate, and the total payment's $390. If you wait till age 50, the cost goes to $12,000 a year. 55, 16, age 60. You're not surprised that the numbers go up, are you? But total amount is much more if you wait. But the problem is something we should talk about, which is, what about long-term care costs? Now, I look at this from a double win perspective. If you die early, the family receives the million. You got a legacy for the family. Early retirement funds are preserved. And under scenario 2, if you live past 85 and you need care, the family coordinates the care. They have the funding to do it. They had $1 million backing it up. And the RIF and the savings are preserved for your living expenses. Now, let me be precise about what these numbers represent. I call these costs virtually guaranteed, and that means the death benefit is guaranteed. The insurance costs are guaranteed. But these level payment projections, we assume the policy performs as illustrated at 3% using the PAR fund as the backstop. Now, this is our starting place, a stake in the ground. It gives the consumer, you, an understanding of what permanent life insurance costs today using relatively conservative and guaranteed assumptions, but there are other life insurance product options that should be considered before moving forward. Non-guaranteed products, different structures, different risk profiles. And life insurance represents just one component of a diversified financial plan for retirement. Not the only component, one component. So when somebody says, that's too much, too expensive, my response is, compared to what? Non-guaranteed products that might cost less, fine, but you're accepting performance risk. Self-insuring and hoping your investments are there at 85, maybe. But hope isn't a plan. Different allocation entirely, that's a choice too. But here's my bias. Plan for the worst, hope for the best. This virtually guaranteed option isn't for everyone. Not everyone should do this. But here's what I've learned. The conversation itself has value. Sitting down at 50, 60, at any time and asking your family, what do we value? How do we want to handle this? That conversation reveals what your family actually thinks about each other. Even if you choose a non-guaranteed alternative, even if you allocate differently, at least you've discussed it. Life insurance in this context starts with and ends with unconditional love. Not many would make this kind of commitment to their family. It's easier to do nothing. But if you're planning early retirement and you think your family before self, like my mother did, you should at least see the math. So it's your move. This is Jeff Cait. Now go. Get it handled. Thanks for joining.